Greetings, everyone. I hope 2023 is off to a great start. Markets are off to a better start than they were last year, coming off the heels of a terrible year. Markets are positive. International emerging markets are leading the way. Investors are starting to feel a bit better, even though they are still beaten down when you look at the sentiment numbers. In this video, we are going to unpack what's good about the market start so far this year and what are some areas that are causing us to pause. Keep in mind, and I repeat this a lot, this cycle is unlike any cycle that we've seen ever. That goes for the business cycle, the Fed cycle, the market cycle. Coming out of a pandemic, there's not really a playbook. So we're leaning on our process. We're leaning on taking our cues from the market. And hopefully this video gives you insight into some of the things that we're tracking. And keep in mind, I'm filming this on Monday, January 30th. So if you see something that maybe is a bit outdated, most of you get this on Sunday, which is about a week ahead. So just keep that in mind. All right, let's get into it. So there's an old saying that so goes the month of January, so goes the year. And I'm usually not a fan of these seasonal quirks, but some of them do stand the test of time, and some of them do hold some water. So this is the January effect. And as the name implies, if the month of January is positive, the market tends to be positive for the entire year. So this data set is for the S&P 500 going back to 1950. And you can see here, when January is positive, the market for the year is positive 86% of the time, with an average gain of roughly 12%. Conversely, when the month of January is negative, the market is still positive more than half the time, but the average gain is much lower, only 2%. What's interesting about this is, as of this recording, the S&P is up right around 5%. So we have today's trading and tomorrow's trading. Many people will be following this 5% level. If the S&P finishes above 5%, the average gain is 14% for the rest of the year. And the market historically has been higher, about 86% of the time. So these numbers are not different, but what is different is the average return. So this is something many people are following. Seasonal factors in investing do play a part, and this is probably one of the most closely followed barometers. This is another spin on the January effect. This goes back a little further, so post-World War II, and it breaks down the time periods a little differently. So this is, if January is up, what happens in February, which there's really not much to report here, but look at the first half of the year. January's up. The first half of the year tends to be overwhelmingly positive, about 5%. And then this confirms what the last chart showed, the gain for the rest of the year, about 11%. So although this is closely followed, although this might have some merit when you compare to the last 70 plus years, this isn't gospel. This doesn't mean if January is positive in 2023, you're going to see a positive stock return for the entire year, but it's an interesting data point. Okay, so that's positive metric number one. Positive metric number two is something that we've talked about quite a bit. That's peak inflation and what happens afterwards. So empirically, looking back, when inflation peaks, that tends to coincide with market bottoms. And looking at this, it looks like if inflation doesn't go higher, we peaked in June of 2022. Okay, and the market bottomed right around October, if that indeed is the bottom. So this is pretty close. So this is consistent. Inflation peaks, market hits a bottom. Of course, things can get worse, but if current trend holds, this looks like it was a pretty good indicator of a market bottom, and that would be peak inflation. So inflation has slowly subsided. It's still too high. This was the last year-over-year figure. So looking at December 22 versus December 21, prices went up about 6.5%. This metric here shows if we get flat inflation readings, meaning month over month changes, MOM is month over month, that are benign or even modestly positive, inflation should normalize to the Fed's 2% target sometime in the spring. All right. So this was the last print from November to December. It was basically zero. And on that path, you can see we're hitting the Fed's inflation target in April or May. It's been rumored, many economists are predicting that inflation this month, inflation for December, which you could pin it on oil prices, consumer spending during the holidays, could be a little higher, which would still have inflation going down, right? But instead of 6.45%, it might come in sub 6, which is, again, still too high. But playing the movie forward, if we got these nominal increases, inflation would still be going down, but it'd be going down at a slower pace. So this is something investors are very much watching, not only to try to measure an inflection point when stocks could potentially go higher, but also getting insight into what the Fed does next. And what the market is pricing in for the Fed is a modest increase of 0.25%. Okay, so the Fed meets on Wednesday, this Wednesday, the 1st of February. The current Fed funds rate is 4.5%. The market is pricing in, all but 100% guaranteed, that the Fed is going to increase by only 0.25%, which would move their benchmark rate to 4.75%. Okay, this is consistent with moderating inflation. The Fed was hiking aggressively, 0.75%. They downshifted to 0.5%. Now they're further downshifting to potentially 0.25% on Wednesday. This is a good sign, right? The next step is for the Fed to completely pause. And what's not often talked about is it's not like the Fed is getting clean feedback. So the Fed's increasing rates, but there's a lag for when they increase rates and the effect on economic activity. So it's not like they increase rates and automatically the economy slows. So there's a lag, there's messy feedback, there's misleading feedback. So there's a faction of investors, and it's growing wider by the day, that want the Fed to pause just to see the impact of their hikes, because the Fed could be increasing rate and pushing the economy off of a cliff. So this natural progression of rate hikes is slowing, which is a good thing. I think that's part of what the Fed is waiting for, this wait and see approach to see how their monetary policy changes and tightening affects real economic activity. The next step would be a pause, and I think the market's starting to sniff some of this out too. So the market saw this coming, which is why things have gotten a little bit better. And the Fed is not stupid. So the Fed's watching something. They're very much watching what markets do, what stock markets do, because there's something coined the wealth effect. Okay. And as markets are going down, people tend to be less confident. When people are less confident, they tend to spend less money. That's the wealth effect. So the stock market can act as a mechanism in and of itself for how consumers behave. Conversely, if markets are going up, which they have the last couple months, people can gain more confidence. If they're more confident, they're more likely to go out and spend money. What the Fed does not want to see is markets sniffing out this change in monetary policy, stock markets racing higher, consumers going out and spending money. That would derail, or potentially could derail, their attempt to rein in inflation. I bring this up because the Fed, one, they recognize this, and two, they've used their forward guidance, what they say, to talk down markets. So this is pretty much accepted. People accept the Fed are going to hike by 0.25%. That's not a mystery. What I'm looking at is what the Fed says. And it wouldn't surprise me if they talk tough on inflation, saying rates are going to be higher for longer, don't get married to lower rate increases. The Fed is going to try to spook the markets. They're going to try to talk the markets down. So it's a bit of gamesmanship, a game within the game. But all in all, inflation, what the Fed is doing, these two actions are consistent. And thus far, the Fed's taken a lot of flack. Thus far, they've done well to mitigate inflation while not driving the economy off a cliff. The analogy that I would use is trying to land a plane in bad weather, right? You can't really see through the windshield. You're getting hit with wind and rain. It's a very difficult task, but they've managed it nicely. And part of that managing it is through their forward guidance and what they say. So the previous slides, my previous comments, are a case that the worst is behind us. The next set of slides might be the case that the worst could be yet to come, or we kind of just flatline in this purgatory and we bounce around. What this graph is a snapshot of the U.S. Treasury curve by yield going back to 12/31 of 2020. Okay, so going back almost 2 years or more than 2 years, looking at yields at the end of 2020. And this goes from 1 month all the way up to 30-year U.S. Treasury bonds. We also threw in the dividend yield for the S&P 500 at that point in time. Now, if I'm an asset allocator, if I'm an investor, and this is my opportunity set, if I can invest in a 12-month treasury and get 0.1%, or I can invest in the S&P 500 and get some dividends, right? 1.5% in yield, and the potential for my investment to go up in value, what is the more attractive trade? Many investors voting with their wallet said the S&P is a much more attractive trade. Furthermore, coming off the last 10 years, so from 2010 to 2020, of course, there were a few exceptions, but for the most part, that was a pretty serene decade for investors. The S&P was up over 10% a year. So there was a belief that this could continue. And, it wouldn't be uncommon for someone to say, why in the hell would I buy a 12-month treasury earning nothing when I could buy the S&P and get 10% a year? That was a very rational asset allocation decision. Fast forward to today. Same U.S. Treasury curve, 1 month to 30 year. This is the S&P 500 dividend yield. It's not so clear today, is it? With all the stuff going on economically, within markets, geopolitics, buying a 1-year treasury and getting 4.65% versus the craziness of the stock market doesn't sound like such a bad trade. So the key message here is there is an alternative now. Back here in 2020, there was no alternative to equities. Now there is an alternative to equities. In our opinion, this is going to be a headwind for financial markets, for stock markets, because they have direct competition with fixed income. Okay, so if you're an all equity investor and you're thinking, hey, I'm going to get 12% a year for the next 20 years of my money, yeah, that could happen, but it might not, because asset allocation decisions are not made in a vacuum. Rational investors look at the opportunity set out there and they make decisions. This would be a prudent decision if you're risk averse or if you're not 100% equity investor. All right, so this is potentially a headwind. But, and I've said this before in our client meetings, if you're a saver, if you're a retiree and need to live off your portfolio, this is a great thing. Being able to generate risk-free income backed by the full faith and credit of the U.S. government to generate investment income off your portfolio. That's a great thing. It's not a great thing for people in debt, people that borrow at the household, at the corporate, at the government level. This is not ideal if you're a net debtor. It's ideal if you're a net saver. Okay. Looking at some other metrics that are screaming recession. I showed this a couple months ago. This is the IM services gauging service activity in this country. This has become more meaningful in the modern era because we are making less into making stuff, more into services. So think professional services, your accountant, your financial advisor, hospitality, travel, things like that. So this goes back to 1997. In essence, when this line goes down, when services is contracting, the services sector, services industry is contracting, this line's going down, that coincides with recessions. And it's batting 1,000. Okay, this line is very much going down right now. Same thing with leading economic activity. So this is just a basket of leading indicators that try to predict future economic activity. Again, when this line is going down, these dark gray columns, both here and back here, signal recession. This line is very much going down. Okay, and I just chose 2 of these things. There's some other flashing red lights. When you look at the yield curve, for one, that's probably the most obvious. You look at savings rates, which have plummeted. You look at credit card debt, skyrocketed. Auto loan defaults are starting to perk up. Housing activities in the dumps. So again, the first half of this video, we talk about things that are going well. The latter half of this video, things that are flashing a recession. One interesting thing that I didn't cover back in my positive comments was when you look at what's leading thus far in 2023, meaning what sectors are outperforming, it's the cyclical stuff that's outperforming, right? Technology, more like riskier corners of the market, which you would not necessarily see if the market was anticipating a recession. Conversely, the defensive names, utilities, industrials are lagging thus far in 2023. If the market was sniffing out a recession, you would expect that to be flip-flop. So count those comments as a sign for the good, a sign for the potentially the worst is behind us. Zooming out and looking at this bear market, and again, I've shown something like this in the past, but it's good to update some of these things. So this looks at every bear market since 1928 for the S&P. And when you look at length, our current bear market is basically right in line with the average bear market of 286 days. We're right at 282. So you can check that box. We've reached the length of the typical bear market since 1928. Looking at the average decline from peak to trough, and I believe we hit the trough in October of negative 25%, there is still a ways to go to reach the average bear decline of 35%. But again, this goes back to 1928, and with that data set, you're getting the Great Depression, which I think skews things to the downside, makes this a little more intense. So if you throw out the Great Depression or move post-World War II, we're pretty much in line with the average post-World War II drawdown. So looking at historical bears, you could probably check both of those boxes that we've reached the average, which certainly we could blow through that. But again, this is good for context. So again, this is an odd cycle. You have certain data points that are saying full steam ahead, the worst is behind us. You have other data points that are saying, whoa, 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 let's pump the brakes. There's flashing red lights. And I know investors are inundated with constant noise, with social media, their social circle, their friends, their advisor, things they read on the internet. What this series is designed to do is, one, to give you insight in the way that we think and what we track, but it's also heavy on market evidence. And we're big on taking our cues from the market. And part of our job is trying to filter out the signal amongst all the noise. And I've said this time and again, but I think it's very underrated that good investing in the digital era in 2023 comes with building an information filter. You can't listen to everything because you'll be paralyzed. You can't only listen to things that confirm your viewpoint. So if you're a pessimist, the tendency is to go out and read pessimistic news. I would challenge those that do that, and that works for an optimist too. Go out and read the opposite. Go out and read something that challenges your viewpoint, because we all have blind spots. Investing is highly emotional, especially when things get difficult. So I hope this series allows you to think better and invest better. And if you have any questions about our process, the way we think about markets, the way we invest money, the way we make buy-sell decisions, feel free to reach out. If you're a prospective client or you're working with another advisor and you want us to kick the tires on your portfolio, go ahead and send us a note at insight@pureportfolios.com. It's free. We're seeing more and more people reach out, and we give them objective, candid feedback. We're not salespeople. We're not going to put the full court press on you, but we'll offer our professional opinion, and we hope that helps. So thanks for checking in. Thanks for tuning in. Feedback always welcome. We'll see you next month.